I'm grouchy. I'm grouchy, Mark.
Hello and welcome to Welcome Home Radio. The waters in the mortgage industry can be pretty muddy, whether it's investing, leasing, renting, home insurance, or myths and misconceptions. Welcome Home Radio has the answers for you, the consumer. And now, to help you make the right home buying decision for you and your family, here are your hosts.
And welcome to Welcome Home Radio, where real estate, lending, and learning do come together. And what a crazy month we've had with technology. We are sorry we missed the last few weeks. But first, I want to wish everyone out there a great 4th of July weekend, a wonderful time to celebrate our country, family, and friends. This is your mortgage market update for June 30th. The biggest news to date is pending home sales. These are signed contracts on existing homes and an increase of 8% over the month of May, which is well above the 1% decline we expected. Buyers are still lining up at a fever pitch pace. Now, in line with this, the MBA released this morning mortgage application data, and overall volume decreased by 15%. Purchases were down 17% year over year, and refis 15% year over year. The ADP jobs report came out for the month of May, and the estimated 600,000 target number, we came in at 692,000, almost 100,000 more than expected. This is a very positive move for a lot of people, and that people are getting back to work. And that is a good thing, and that should help us in the mortgage area. So how do we see this for home buyers? How do home buyers get the best mortgage, and what is best for them? Do we understand points, fees, down payments, PMI, MIP, ABC, XYZ? But today we're going to be talking more readily about the market, what's going on, as well as what are the best mortgages loan programs you can use. So welcome to Welcome Home Radio. And as always, my co-host Alan and Tom, how are you guys? Happy 4th. Hope you have big plans this coming weekend.
Oh, big plans.
Wait a minute. What happened to Abe? Where's Abe?
I'm teaching today. So I know. I'm in remote Fort Worth today. Fort Worth, Texas. I love Fort Worth.
Well, you know, I'm going on the Grapevine train over to the stockyards this weekend.
Oh, man. Well, come visit us.
I have never been on the train from Grapevine to the stockyards and back. So we're doing that on Saturday. It's going to be a lot of fun.
Yeah, when Marin was about 6 or 7, we took it over there because Santa was going to be on the train. And sure enough, that was an event.
Oh, it was?
Oh, yeah.
I understand they have murder mystery train and everything, but we're looking forward to it. We've got
all sorts of stuff. Exactly.
12, 15 people. Alan, you got plans this weekend?
No, sir. We're going to stay in town. I think one of our neighbors is having a pool party. We're going to pop over there maybe and have a little barbecue. But other than that, it should be quiet and enjoyable.
Do one of those stay vacations?
See.
All right. Well, listen, guys, today's topic really, tips on getting the best mortgage, but also we want to understand what's going on in the market. there's some crazy things today that I have been seeing, especially across Zillow. And Alan, you can speak to this. Homes are staying on the market longer. There's homes that are on there for 60, 70, 80 days so far. And we're supposed to be in the prime buying months. Homes are just coming up. There are a lot of homes still getting over asking, but is this trend starting to spread out? We're getting more inventory. What's happening out there?
I kind of sensed it maybe about 2 months ago. And on some of our real estate boards on Facebook and other things, I was throwing it out there to see what other people thought. And some people thought, no, it's still extremely tight and all that. But others are saying they sense it ever so slight. It's a good thing. I hope it's a correction that's happening in this speed, let's put it, instead of just an absolute stoppage. So things are happening. People are getting back to kind of a normal life versus the stay-at-home thing all the time. And maybe we are getting back to a more normalized type market situation. But that said, if you have a nice home and it's ready to move into, it isn't going to be on the market 60 or 70 days. Homes with issues, yes, but price is still, things are worth what somebody will pay for them in all cases. So houses are no different, and the nice ones go fast. Even the medium nice ones go fast, but the average to below average, people now think they cannot jump on it, and they can maybe look a little longer.
Well, and the jobs report is showing people are getting back to work, and that's a good thing. Tom, how are you seeing this impacting the market and what's happening? I mean, are we seeing maybe a slowdown on these prices and more inventory, or are we just seeing buyers beware? They're checking themselves better. What's going on?
Well, you do have kind of the pie in the sky thing. I think is finally everybody's getting their piece of pie that they wanted, and they're finding it maybe a little bit more bitter pie than they like. And what I'm referring to is that I don't want to be in bidding wars and be the last person in a series after 2 years or 3 years ending up with that highest price. So there's some reality check that's going into it that say, the seller is asking $400,000 for a house that a year and a half ago they would have asked $350,000 for. Maybe I don't really need to be in that house that much at this point in time. And, albeit the rate's going up slightly. Oh my gosh, 3 1/8 instead of 2 7/8. Oh my, panic time. I think the real play.
The sky is falling. The sky is falling.
I know. It's Chicken Little. Let me tell you, the sky falls when it's 16 and 17%. That's
exactly. We're still in historical lows.
But the reality just is, I think, a mindset that says to people, I can't just keep being on this, train going up. Now, as soon as I mentioned that and talk about that, my sister took her house off the market and was going to deal with some things she needed to deal with regards to selling it. And specifically regarding, she has a place in the back that a tenant lives. And so it wasn't the best showings when they went back there to that part of the property. But the long and short of the story is that she put it back on the market with that only being a cursory resolution as far as what she got done with the tenant. And it still sold pretty rapidly for above what she was asking. And I think it still deals with location as far as demand is concerned. And Austin market is still beyond the sky, but Houston, parts of Dallas, parts of Fort Worth, those big markets, San Antonio. And of course, by teaching with champions, I get students that are in all these different markets and the different professors that are in these different markets that are actively realtors doing their job. I'm getting an impression, as this conversation started with, that we're seeing a modifying of the high pace and heavy pace, except of course in specific locations. and it still maintains in certain specific locations. And I give that example of Austin. Well, Austin, by its very nature, can't have too much housing. I mean, there are so many restrictions with building in Austin proper, and there's so many hoops you have to jump through. Austin's going to be one of the last markets to see a decrease. And also, you got to keep in mind that their economy, the job market there is a lot driven by the technology end and people making, big six-figure incomes, with households that are both making, partners or people are making 2 six-figure incomes. So when they're making $250,000 a year, that sure does make the possibility of paying $1 million for a house much higher. But
what is happening?
I think you've got a good point with regards to the average type of circumstance we see is in somewhat a modification at this point.
I've got to ask the question, and I think our listening audience would also be interested in understanding, is there really a material shortage, or is there just delays that have increased prices, and are we seeing a change to that?
Well, I think, I mean, from what I read and from what I can see and from the information I get as far as suppliers are concerned, there's a shortage. The supply chain is having a real difficult time recovering from last year. And you can't just automatically have board feet of lumber in the millions that we, of course, use in the United States every year suddenly be resupplied when we haven't been manufacturing it for 6 months, 8 months, 10 months, that type of period. Or we've been doing it at a very modified scale. So the legitimacy of a shortage of materials, I believe, is legitimate. And of course, what the industry always does, this happens with gasoline, obviously happens with housing, but everybody will always charge as much as they possibly can get if they know they're not going to lose their market. And that's kind of the key thought behind all this, that if we're seeing we know there's not an oil shortage. We've got as much oil as we've ever had, but the asphalt roofs and the asphalt that's used is created from the oil to create shingles. There just hasn't been the amount of industry emphasis to create the amount of roofing that we need right now. And so supply and demand, if you don't have enough supply, we know demand will bring that price up.
And there's demand and supply problems across the board, I think. And I agree with Tom. It's really legitimate. Little things like, I was trying to buy me and my wife a bike, a nice bike. They're hard to find. You go to a bike shop, they don't have bikes. You go to, get a new car, they don't have cars. So there's a lot of stuff going on. Housing's in that too, because of all the products in a house. There's shortages of chips for the computers, shortages of chips for houses too, that go into the products that go into houses. And you see it everywhere right now. And also the lumber, people have to honor what they paid for that lumber. We have to go through the high price, and it's coming down, but they still have to honor those contracts that they bought the lumber at the higher price. So I think the lumber part's coming back to earth a little bit, but I agree with Tom that the material shortage in housing is absolutely real.
Okay. Well, then we should still continue to see the new homes being built is still going to slow down, is what you're saying. The best route for most people are existing home sales. Is that correct? Can I assume that?
Well, the pace in which they're being built has slowed down because of the supply chain.
Yeah.
And the supply chain as far as workers. I mean,
Yeah,
there's a lot of people that can do framing and that type of deal. We have, in our industries, we have a lot of people that need or want a job, but they don't have that skill set to be able to do those types of things. And there's high demand there. Sorry.
Market right now with the new homes and the resale, there's a lot going on within the real estate community, like supply and demand. So a lot of the builders have limited commissions on homes. They've reduced them. I've been through this before. This too shall change, but they don't feel they're on quotas, a lot of them. They can only sell so many a month. And so they don't feel they need to offer realtors what they used to offer them to get their clients to come in here because they're so busy. Resale, same thing. A lot of realtors are cutting their rates because they want market. And inevitably, I mean, that's not a new thing in a time where we don't have enough inventory, but when it changes and it becomes a buyer's market, that'll change. So as far as new construction versus resale too, it's two different things. A lot of people like resale. They want to fix her upper. They want to grow into it. Others are like, I don't have any money to fix anything up. I just want to get a house that's new and I can move into it and move on. So it's two different things there. And that's just kind of how I see it.
Well, I'm intrigued that through this, our pending contracts, home sales went up, but yet our mortgage application data decreased this month. So we're seeing buyers coming and going into the market. Refis are even down. So, Tom, give us an idea right now. Rates are being held low really due to the Fed and their purchasing power right now. And they don't see right now any change in that through the end of the year. Is that correct? Am I correct in what I'm hearing from the Fed?
Well, I would say the inclination is that would be the case. Jerome Powell did come out and mention that maybe keeping the Fed rate at zero or near zero is not such a good idea when the economy starts warming up and you're seeing some inflation, which they are seeing, but they're
not some inflation.
They're real slow to acknowledge that.
We're at 4%. I mean, they're supposed to try to keep it around 2%.
Well, and it looks like it might accelerate to closer to 5%. So these are items that maybe, and I do understand Powell's comment that this could be a one-time thing. I would say that is possible, but I would really feel like it more naturally, and I don't live in Highland Park like they do, where they can send somebody to the store, but I really do feel like, nor do they care what their charge bill is for milk and bread every month. But the fact is that the end result, we will see an end result that I won't say will take the Fed by surprise, but it will be more of a kick in the pants when they finally say, well, we really do need to raise the Fed rate up to 0.5% to slow down this inflation, 0.75% by the end of the year. Once they start planning for that, you'll see things change. Yeah. Yeah. So, I mean, I always love interest rates at least 3 or 4%. That way my savings, if I'm putting it in something secure, would get 3 or 4% and beat the rate of inflation. I haven't understood the continuance of using, the Fed rate and buying up mortgages as a necessarily good methodology to do financing. But
do you think it's causing dependency?
I'd say that since 2008, we've always gone back to that same crutch every time we needed help. And so, starting last year, and we went back to that crutch and rely on
the same reaction. It's the same reaction. Throw money at it, it'll solve itself.
Well,
yeah, there's a lot of
too much there.
Equations. I mean, think about 80% of the United States working public doesn't have $20,000 in the bank. Okay, some of them don't have anything, so they're living off credit cards or living off of borrowed money, and there's a lot goes into this stuff. The little people, all the middle class are the ones that always get hurt in these situations. The upper class, they don't care if it's $5 a gallon or for gas or $2.50. They could care less. But there's a lot of people that are, they're in the crosshairs right now because there's no way there's not going to be some more inflation. It's happening. We've been talking about this on this show for probably 6 months, and here it is. Stuff has gone up. I do all the grocery shopping in this house, probably 90% of it. Every time I go into the store, it's a little bit more every single time, because it's not just the products, it's the products that have to, starts with the raw materials.
And as Tom is eating in front of us and didn't bring enough for everybody, so,
I was going to have Grubhub send you something.
He's one of them guys that can afford the store.
I'm telling you. Oh, there you go.
There's a lot of trickle in that with the trucking and the manufacturing, and so things are just going to continue to go up. It's going to be. I think it's going to get much more serious, personally.
And so, with that understanding, and with inflation, and with rates, I think we can temper our message of understanding what's the best mortgage. Right now is a great time, still historical low rates, but in shopping for a rate, shopping for quoting, sometimes you need to look at other things outside of fixed mortgages, being an ARM, an adjustable rate mortgage, if that works for you and if it's a short term. But we're going to see rates becoming important more, in my opinion. And therefore, Tom, I want you to talk real quick about interest rates on the mortgage and then APR. What is the real difference?
Let's start with the interest rate on the mortgage itself. And I do want to convey a story that you just give me a great segue or lead into. I'm now teaching CE again, right? So continuing education, I get people that are in the industry coming in, and we basically spend 8 hours kind of picking apart where we are and what we're doing. Of course, we got a curriculum we got to teach at the same time, but it's a great chance every year for me to catch up with exactly what is occurring in the marketplace. And I had a student this last week who just got finished closing an adjustable rate mortgage at 1.75% for 5 years.
So a 5-in-1 ARM at 1.75.
Yeah. And actually it's a 5.2 because it can adjust twice a year, each year after it starts adjusting after it's fixed for 5. But 1.75% was like jaw dropping. And I said, are you kidding me? So when I saw the topic this week, when I was in the class last week, I was thinking, this will be a great thing to bring up. Now, the APR, when they calculate the APR on that loan is about 1.65. Now, the reason why it's low is all adjustable rates will be below whatever your start rate is, because they can go what? They can go up and they can go down. So there's a consideration to go both ways on the APR. APR, I think sometimes, as far as leading people into the best lender, can be well used if you understand what goes into the APR. In other words, if you have a lender that wants to sit down and describe what a PFC is. PFC is a prepaid finance charge, and those are designated charges by the government that say we've got to add this in order to properly calculate what your cost of your interest is over the life of the loan. So, APR can be a very good tool to measure what you're getting, but it also can be deceptive because you can change an APR by simply putting that somebody is paying 1 day of prepaid interest on their loan closing the end of the month, when they're closing instead on the 10th of the month, and they're going to pay 21 days of interest. So there are some things in there that can be manipulated. So I always tell our listeners, make sure you're getting the full explanation. And if a lender can't describe and explain what APR is, then I would probably be looking at the other lenders that can.
Well, and you definitely be asking for a loan estimate.
Absolutely.
Definitely get a loan, an LE requested from the lender, so that you can review it and compare it, because somebody may be giving you a great interest rate, but they're also charging you a lot of points to get there.
Well, that's exactly right. And the LE will show and be a guarantee about what your cost of your financing will be up until the end. And it can't vary by more than, on a fixed rate loan, by more than 1/8 in the APR itself. Meaning
So,
that
let's take a step back, Tom. You said something. A quote from somebody is flexible. It can change whenever. An LE is not. It is lockable. This is guaranteed to what we're holding ourselves accountable to. And so explain that to them so they understand.
Sure.
Getting a quote to getting an LE are two different things. And not a lot of lenders like giving out LEs.
Right. Yeah, they have two different forms to tell you about cost up front. You have a fee worksheet, and the fee worksheet is basically what I call the liar sheet, because it says at the top of the fee worksheet, it's required by law that it says this, that get a loan estimate. Your cost and your charges may vary. For an accurate accounting of what you will pay, get a loan estimate. So that really takes out that fee worksheet and kind of throws it out in my mind. So you want to take LEs and compare LEs to your different lenders with regards to, getting the full picture. And the APR disclosed on the third page of that LE, there can be a distinct difference. I'll give a personal example. Last year, I bought an investment property. I financed it. And because when I was financing that property, I went out and actually had 3 of my friends send me estimates. And they sent me loan estimates because on the third page, I could sit down and look and compare the 3 different estimates on this property I bought out in Tyler. And that property was reflected a difference of nearly 0.35% between the highest and lowest APRs. Also, the highest and lowest as far as the cost, there was more than a $5,000 difference between the highest and lowest estimates I had that I would pay in the first 5 years. So the loan estimate can be an ultimately great tool to be able to measure when you're buying a home as to what it truly costs you to get the mortgage, to get the financing. And it's just a matter of knowing where to find that, or having a good loan officer explain, hey, if you're going to compare me to somebody else, let's sit down and we'll go through them together so you can see. And I may not be the best one, but at least we'll go through them together so you understand better.
The overall cost of one. I've had so many clients that just base it on, well, this person's giving me a better rate. Is it in a loan estimate or is it in a quote? And they never want to respond to that because they don't want to admit, well, it wasn't a quote. It was a quote. It wasn't an LE. And by the end of the contract and closing, we weren't able to get to that, or I ended up paying a lot more. So one of the other things I want to bring up before Alan comes back with some of the more important things of market, I do want to say hello to David and other listeners out there. We appreciate you. But I want to talk about, Tom, PMI. Since conventional mortgages are one of the mainstays right now, PMI and upfront PMI. Sometimes there's a big value, especially if you plan to stay in a home longer than 5, maybe 7 years, to pay upfront PMI. And that is not an option I hear a lot of people asking for or aware of, that I could get rid of this upfront, especially if I'm staying in the home. Is it roughly 7 years or 5 years that can be paid off and done?
Well, the mortgage insurance is based upon the amount you put down over time. So if you put down 5%, you'll pay mortgage insurance on a conventional loan for 11 years. If you put down 10%, it'll be 7 years. And if you put down 15%, it'll be 5 years, roughly. And because of that mortgage insurance, if I was going to be there putting down 5%, I might consider doing the upfront premium, which allows it to be locked in and paid for all up front through your financing. Now, you're going to end up with a higher interest rate because of that, but the overall cost can be diminished because your rate isn't so high in comparison to the increase in the interest rate. In other words, the mortgage insurance might cost you 1.09%, whereas the interest rate overall increase might be 0.25% or 0.375%. This again falls back into your loan officer needs to be educated in this in order to help you and protect you as a consumer the best they possibly can. And lots of loan officers do not spend the time with their mortgage insurance reps to go through the process of being educated, whereas every mortgage insurance rep I've ever met would love to take you out for lunch and sit with you for an hour and explain their products to you, every one of them. But we tend to, in our industry, kind of poo-poo that, well, that's just something that's got to go with the loan, instead of understanding the different types of mortgage insurance that could affect you over the long run with cost, how much they cost or not.
Well, and the cost one, but then if I'm looking at it from a borrower's perspective, a buyer's perspective, I'm going to save $120 to $300 a month over the next X time, not having to pay that. And if I'm staying in the home long enough, that becomes the best option up front, as opposed to now, if I'm selling the home in 2 or 3 years, that may not be the best option. I've wasted some money there. But you have to be aware to ask the question to get the answer. And again, we're trying to give tips on the best mortgage options out there. What are you looking for? Yeah. This is a critical one.
Yeah, absolutely.
Now I'm going to go to Alan real quick and talk about, Alan, right now in our market, I'm a buyer. I want to be able to buy a home. I have options. I'm a veteran, let's say. What is the best loan out there that I need to go to be able to buy a home and do it as quickly as possible? Because there are differences in the loan programs to what sellers and seller reps look at. Is that correct? Am I saying wrong?
Well, let's take it two different ways. Forget facts for just a minute. The way the market is right now is listing agents in general and sellers obviously prefer cash and a quick close if they can get it. Second place right now is conventional.
Cash is always king, isn't it?
Generally, yes.
Okay.
But there are times when cash gets beat still. If it's too low, it's not, not enough. But conventional loans are in second place, behind cash. And then things within the contract itself are manipulated to make it more attractive to a seller. Lease backs, option fees, who's going to pay for title insurance, things like that are all in play. And then back to the loans, listing agents will look at FHA and VA. Typically that's not the preferable thing right now. There's some exceptions, VAs. There are veterans that own homes that do like a VA loan. They like to work with their brothers in the armed forces. And so we tell our buyers, if that's the case, to, write a letter, get personal, talk about your background a little bit. And we bring in the strongest possible offer we can with all the words and the correct feelings. There's real heart goes into these letters. So that's that. But back to the money in general, that's how it is right now. And now on new construction, the thought out there right now is there's less of a hassle with home builders. They love, they'll take VA loans and FHA loans and conventional loans and all this other stuff. So that's the conception, that's the perception out there right now and how it goes. What we started the show off with, and I think Tom and I agreed on this, is that, and you too, Blair, is that the market, slight little rethinking of how much we're going to pay for a home. We don't have to overpay necessarily. Okay, so that's in play also. And that's just kind of what I've been noticing out in the market. That's what I see. I'm sure David, who's listening, would probably agree with a lot of that.
Sure. And again, all of our listeners, if you have a comment, you want to share a question, please put it up on the screen. We love your comments. We love to respond to them as quickly as possible. But in an effort to do the best mortgage for a client, there are options. And as you put it, you gave the priorities. Cash is king, conventional, and then, of course, VA, FHA kind of come in third there. I don't hear USDA, which is a great option, but it's geographically limiting to certain people. So generally, that's not in play. Now,
But just right there, real quick, the USDA thing 15 years ago was cooking.
Yeah.
We had a lot of areas that qualified, but Dallas is filling out. Fort Worth
It
is filling
is.
out, and so those have kind of gone bye-bye for a while.
Well, we have a lot of people. Again, I don't have a number on the top of my head except to have old numbers, historical. We have a lot more people moving to Texas than Texas leaving. So, and I've even seen the California Facebook page, California to Texas, here we come. I see a lot of our growth in the veteran world has grown. We are literally getting 100,000+ veterans a year annually moving to Texas, not only because of the great benefits, but because of the tax laws as well as other opportunities. So good things to understand. Now, the best loan sometimes, and we kind of talked about PMI, Tom, but some loans are down payment and they have options, 3%, 5, 10, 15. You gave an interesting little data point, the change of interest rate to the change of the loan program. Okay. You gave an indication that, hey, if I put 3% down, they're going to charge me a little bit more on interest because I'm putting less skin in the game. But if I go at 5 or 10%, where do we see that change of interest rate? And how would you describe it to our listeners? Hey, you get a better interest rate. How about if you waive escrows or not waive escrows? If you put so much down, are you understanding my question?
Yeah, what to address there is, and for the listeners that we have today and in the future listening to this, the thing I teach in my class is about LLPA, loan level pricing adjustments. And these are consistent with every investor nowadays, period, end of story. They have become very sensitive to risk. So an LLPA, a loan level pricing adjustment, is based on the loan, different levels. You'll be charged more for different things you're adding or taking away from the loan. So I always give the example that I've got a buyer that wants a $40,000 condo. They're putting down the minimum they possibly can. They have 620 credit scores. They're not closing for 60 days. They need money from me pricing the loan up to pay their closing cost. Every one of those things that I just mentioned are what we call loan level pricing adjustments: the type of property, the amount down, the credit score of the borrower, how soon they're going to close. Those were all additions to what we call the pricing of the loan itself that are mandated by Fannie Mae and Freddie Mac. And now FHA has kind of joined that crowd and horse. I mean, I remember the good old days when you'd have a 600 credit score, there'd be no added cost to the loan if I did an FHA loan. And so we'd often talk to somebody about, let's do FHA, because if I'm doing a 620 for Fannie Mae, you're going to have this higher rate by this much. Today, everybody's sensitive to that. All those things that we talked about. So somebody having bought a house 10 years ago will actually see, they would call out in the marketplace or follow the internet and see what the rates are. The rates are reflective of what would be considered pretty much a par quote. In other words, rates that are not affected by LLPAs. What happens, though, is once they get with the loan originator pulls up all this data, compiles it, puts it together, and the price that's spit out says, look, the normal person would get a 3% rate. We're giving you 3.5%. And when that happens, people come unglued. Well, find a different property, get your credit back in place, get a bigger loan, put more down, and get all those things done, and you'll fit in the other box that allows us to give you that 3% rate. And so the reality is people don't understand that we now are really driven by individually pricing loans. They're not really in this big, huge tranche or collection or bond pool, as we call them, of mortgage-backed securities, we're hierarchied within the bond package as to risk is how it's involved, and then pricing the loan accordingly.
Can I give some overview, and you correct me where I'm wrong? One of the critical pieces of that risk is right off the bat is the loan amount, not the purchase amount, the loan amount. And if you're not in the six figures, if you drop below six figures, that's generally an eighth of a point difference in interest rate. It's going up because, and if I could explain this, if I have an investor with $1 million, I don't want one buyer at $1 million home, but I also don't want 10 $100,000. I want 3, 4, 5 out of that $1 million investment. I want to be able to divide that up to 3 to 4 properties, and so that I have it in a good risk factor of being paid back. Is that correct?
Well, and if you think about if I have two $500,000 loans in that $1 million pool, one goes bad, what happens? I got 50% of my portfolio dropped into the trash. If I have 10 loans of $100,000 apiece, then you have to actually get the additional cost of additional servicing and additional maintenance of those loans that now adds cost to you. So your sweet point, your sweet spot at $200,000 loans is ideal for an investor to spread risk out and still minimize the amount of servicing that's created with regards to that pool of loans that you've invested in.
Now let's talk about some other factors that impact rate, those LLPAs that you're talking about. One of them I brought up, which is waiving escrows. If I put 20% down or more, I have the ability to say I will pay my property and insurance on my own. They increase that risk roughly about an eighth of a point. And that's due to the fact that, hey, I'm not earning interest on your money sitting in my bank for a year. Is that pretty much why?
Well, I would say that, except the interest that they're making is 0.05%. So it really is driven by the fact that the investor is looking at, what if you don't pay your insurance and we don't catch it? What happens if you don't pay your taxes and we don't catch it? Because they'll immediately make that up and pay it so it's on the house, and it's going to cost you an arm and a leg for screwing up like that or trying to deceive them and cut that cost. But their risk is associated as higher. Yeah, in the good old days where you made 5 or 6% on somebody's money, I'd make that argument a little bit more so that that's what it favored. But today, even on $1 billion at 0.05%, yeah, I know that's some money coming in, but it's a lot riskier for them to sit there and go, can I trust these people to make this payment? I'm going to have to still check on them. So I'm still actually doing what? I'm still having to hire somebody, a servicing department that will make sure the records are correct and county reflects the payments have been made on the taxes, and that a mortgagee can be located as far as the mortgagee clause, who is covering the house. So my argument, used to be, yeah, just like you just intimated, that they can make a whole heck of a lot more, blah, 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 when in reality, they've got this expense and risk that counterbalances.
It's really driving because of the risk and because of the Fed at 0% and earning of that.
Yeah.
So that is one factor. Now, another factor in changing is that how much you put down payment. At an FHA loan, MIP is standardized at 0.85. Everybody gets that, whether you're at, that's why a lower.
Well, once you put down 10%, it goes down.
I understand. But if you're using the FHA loan, one, because of credit, and two, because of you don't have the wherewithal, that's an opportunity to control that PMI. But the other thing, and I just had it on the tip of my tongue. Oh, no, I've lost it. I can't believe my thought.
My daddy always said, if you can remember you forgot, you ain't got a problem. So don't worry about it.
Hopefully I'll forget about it and go.
Why am I in this room?
Yeah. Where'd Abe go? Oh,
This is one of those embarrassing moments that hopefully the listeners are having some connectivity problems.
Well, I'm trying to bring up about all of those LLPAs that impact that pricing mechanism and allowing us to understand if you're putting down payment, a 10% makes a difference to 5%, or right at 19%, you can get a better rate and then pay that off, but you're still having to stick with PMI for 2 years. That stays on. If you have PMI, it stays for 2 years minimum. Am I correct in this?
And technically it's 1 year. Mortgage insurance companies will convince you it's 2. It's 12 payments.
12 payments. Okay. So that's good news.
On-time payments for 12 months, the previous 12 months, under the Homeowners Protection Act says at that point you can apply to have your mortgage insurance removed if certain conditions exist.
If we're at 20% or better on the value.
Technically, if you paid the loan amount down to 20, if you paid the loan amount down to 78% of the original appraised price or sales price, whichever was less.
So 12% equity position.
22%.
22%. Yes. Sorry. Again, I'm in that zone right now. I don't know where I am.
No problem. Let's see, 100 minus 78. Well, with the remainder of 10.
Well, I want to turn it over to Alan. Alan, what do you have to say to our listeners in reference to not only the best mortgage, but what's going on in the market and what's best? Because, again, applications are dropping. We're losing opportunity, refinance, and buyers. What can you help them to understand what is the best opportunity for them at this time?
Well, that to me, my way of thinking, that never changes dependent, it's what an individual wants. What do they want out of life? Is it time for them to move on from renting to buy a home? Then I would make an argument now is as good a time as any. It was as good a time 2 years ago as any and 4 years ago as any. It depends on your timing as a family. And that's how I embrace my clients. Their time is their time. Now, things happen in people's lives. They go through things, divorce and, death and loss of job. And so you adjust. Sometimes we have to wait a couple more years, things like that. But no, in general, I always encourage people that if you want to buy a house, then let's go out and get one. And we get the best loan we can get. We try to qualify as good as we can qualify. That's why we call you, Blair, to get the best qualification we can. And we rely on your expertise to guide us along in that part of it. You do the lending, I'll help with the real estate part. So I stay in my lane, but I always encourage, and I don't care what price range. It is what it is. If it's your time and you want to be in a home, then let's go get you a home.
Amen to that. That is so good. Well, guys, I've really enjoyed it. It's great seeing y'all. Thank you for your time today. I hope this has helped some people out there. Our next show will be next week. It is on the 7th and then on the 21st of July. But I wish everybody a happy 4th of July. Any final words?
That'll do it for me. I'm happy 4th of July, everybody, and we'll see you next week. And if you want to buy a house, get pre-approved. I'll take it from there.
Amen to that. Tom, anything?
I'm wishing everybody the best. Absolutely. Be safe. Be safe.
Amen to that. I'm Blair Thomas.
I'm Tom Holm.
I'm Alan Pace.
God bless.